Hello, everyone, and welcome to today's webinar on the founder-investor relationship. I'm your moderator, Lester Holt. Brian Parks with P2B Investor, and I'm joined by two founder CEOs today who have collectively raised over $40 million in angel and venture capital for their SaaS businesses. Over the next hour, we'll focus on two key areas. First up will be the path to capital, or how to bring investment capital into your business. And then we'll move into investor relations, or how to manage the money and relationships you've brought into your company. So we'll first start with some housekeeping and introductions, and then we'll get into the content. Quick housekeeping. The intent here is to have a full hour, a 40-minute discussion followed by 20 minutes of Q&A. If you do have any questions during the webinar, you can just enter them into the chat window there on your left, and we'll do our best to get to them in Q&A. We will also send along a copy of the deck and the webinar recording to all registered participants. So we're keeping it founder-centric today. We have Andy Wilson and Jack Newton joining us. Thanks so much, guys.
Great to be here.
Thank you, Brian.
Awesome to have you. And Andy, we'll start with you and then follow on with Jack. If you guys could each tell us a bit about yourselves as founders and the companies you're building, that'd be great.
Sure. Yeah, so this is Andy. I'm founder CEO of Logical. We're one of those companies that started off as a services company and then pivoted into the wonderful world of SaaS. We built a product that helps legal teams all around the world sift through large amounts of data for things like open records requests. If you remember the Hillary Clinton email stuff, people use our platform for that, as well as for litigation. So everybody knows litigation's this ridiculously expensive thing. We make it a very affordable thing and something that you don't need an army of attorneys to do. That's us, and that's me.
Great, thank you. Jack?
So my name's Jack Newton. I'm the founder and CEO of Clio. Clio is a cloud-based practice management system. And we like to think about Clio as the operating system for a law firm. So in the same way, Salesforce.com is something that runs a salesperson's day, Clio is something that a lawyer uses to run their day, everything from client intake to time tracking to billing to secure client collaboration, as well as all the logistic stuff like calendaring and task management and document management is handled within Clio. We got started in Clio back in 2008. In 3 days, we're going to be celebrating our 8th anniversary of launching. So we've been around for a while, boast over 150,000 users in 78 countries. And my background is computer science. I'm a product guy. I hand coded and built the first versions of Clio, and now we've grown up to a 200-person company.
Excellent. Thanks, guys. Two very real CEOs with very real companies here today. So excited to have you guys both on the horn. I'm Brian Parks, here coming to you from Denver, Colorado. I have nothing to do with legal tech other than knowing a couple of legal tech CEOs. I work with P2B Investor. That's who you have here today. So while we're keeping it founder-centric, I did want to quickly touch on the investor perspective. So we've got a few quotes here for some names that I think some of us on the line will probably recognize, some pretty well-known venture capitalists. And really there's three broad themes that I think we see here. The first one being that this is a complex interpersonal relationship that is often not considered and discussed enough. We talk about raising money, but we don't talk about what comes along with that, I think. Number two is it's really not an investor's job to tell CEOs what to do. It's good to see that from the investor's perspective. I think Jack and Andy would love to hear you guys' thoughts on that here in a second. And number three is that this is a long-term relationship-driven game. This is not, just a transaction that's over once the money hits your bank account. This is a multi-year relationship. Guys, do you have anything to add here at this moment, or we can touch it as we go along?
I agree with everything that's here. Yeah.
Same.
All right. Good deal. Good alignment with the investors. So that brings us to what we're here to do today. And so really our perspective, as you just heard, is in line with that of the investors. We think this relationship between founders and investors is a topic to address proactively and one to hopefully design for longevity and success. So that's what we're here to do today. Jack, Andy, if you guys have anything to add about what makes you guys passionate about this topic and why you're here today.
Sure, I can go first. I think, this is Jack, by the way, I think it's a really overlooked topic when you're talking about investment and talking about building a company. There's a ton of content out there about raising capital, about negotiating term sheets, and everything leading up to around. And then I find, there's a pretty steep drop off in terms of quality content in terms of the morning after, building a great relationship with the investors you just brought on board and entering into what's one of the most important business relationships of your lifetime. So that's why I'm passionate about sharing my perspective on this topic.
Yeah, and this Andy, I totally agree with that. We've got some great SaaS bloggers out there, Limkin, Christoph, David Skoke, and many others that write a lot about the machine of SaaS. But one of the biggest pieces of SaaS is people. It's software as a service, and then the people that actually run that service, and investors are a big part of that. And it's probably one of the biggest things that entrepreneurs can do is to find the right investor for them to really help them build that big, long-lasting product and company. So I'm really happy that we're talking about this.
That's great. I think that was a tweetable soundbite of one of the biggest pieces of SaaS is people. I don't think we'll call that SAP or PaaS because I think those stand for other things. But I like that.
People as a service.
We'll leave that be. All right, great. Thanks, guys. And so as I mentioned, first we'll touch on the path to capital, getting money into your company. So really we've got Jack's going to lead us through this section of the presentation where we have 3 stages of investment. And then Jack and Andy will kind of walk us through each of their capital paths. So I'll kick it off really quickly with a very high level simplified slide that looks at, kind of 3 stages of investment. So you've got, you start off with a little bit of friends and family money, followed by more professional capital in the form of, angel investment, which could be individuals, syndicates, could be even micro funds. And then, eventually you move into the realm of institutional capitals from VCs, private equity groups, and potentially even the public equity market. So very simplified here, we're kind of looking at a demarcation zone here of pre-product market fit and post-product market fit. And then really, as you're at the 3 money bags down there, you're going to move from an A to a B to a C and on and on and on, hopefully, or potentially as you scale your revenue and the opportunity. So down in the bottom right there's a great resource provided by Christoph Jans called the SaaS Funding Napkin. Does a much better job and much more detail of explaining this. And with that, I'll be quiet and turn the next few slides over to Jack here to walk us through these stages.
Sure. So I'll walk through my example of the fundraising cycle we went through with Clio. So first of all, there's the pre-seed round, your friends, family, angels, sometimes called a friends, family, and fools round, where you've got an idea and you need enough money to get the idea off the ground. Maybe just get the basics like incorporation, some of the basic legal structuring stuff set up, and enough to build hopefully an early product prototype. So in Clio's case, we raised about $100,000 that got us through our first year of development. So that was myself and my co-founder, Ryan Govro, working full-time on the product over that year, obviously sustaining kind of a ramen noodle lifestyle with that. We were lucky. We both had wives that were working and were able to support us in those very early days. We raised as little as possible to get us through that first phase and kind of build the first initial product prototype. The next round for us was the seed stage round, where we raised, in our case, about $1 million of seed funding. And I think where you'd be where most companies would need to be at this phase is showing at least some clear traction in the marketplace. It could be early traction, but again, I don't think you've got an idea on a whiteboard at this phase. Ideally, you've got a product with some early customers that are either already or have committed to paying for it. Sorry, just getting some feedback here. We raised about $1 million from Principal Cancer. You mentioned earlier, Brian. He led our series stage round. Brought in other investors, and this really helped us build out the product, start investing in some marketing, and started seeing some really great traction from that front. I would also comment that as you're going through these phases, the approach that we got was the approach we took to building out the investment rounds was take each investment round and plan on undertaking an experiment with the investment rounds, especially as it relates to customer acquisition. And I think the best thing you can take to an investor as an investment
your line is
basically for them to wrap their head around is the idea that they're investing in something that you've proven out at a small scale that you can double or triple down on. So I'll use an example from our seed stage round. When we took on that $1 million, we were able to start proving out customer acquisition via Google AdWords. And then when it came to raising our Series A round, we were able to say, here's some early traction in Google AdWords based acquisition. It's not huge, but it's a great early indicator of success. And investors always want to be investing something additional into something they feel is already working. So that was our seed stage round. And again, investors are investing in this kind of round because they believe they can get, at least a 3x return on their investment investing at this stage, if not something closer to 10x. And finally, stage 3 would be the follow-on rounds, which can be your B, C, D, and beyond rounds, which are often going to be doubling down on bets that have been working. So if you're able to take on a $5 million investment round, for example, and see some scale from that, some growth from that, and you believe your customer acquisition channels are scalable, the follow-on rounds here will pave the path to an IPO. And some of the rounds done at this stage are huge rounds of, in some cases, hundreds of millions of dollars. In our case, the latest round we raised was a Series C round led by Bessemer Venture Partners. It was a $20 million round. And again, when investors are investing at this stage, they're looking for investments that they believe can be 10x returns on their investment, typically looking for companies that they see a path to at least a $1 billion outcome would be the ideal. They're looking for unicorns. Brian, I'll hand it back over to you.
Yeah, perfect. Thanks so much, Jack. That was great. Andy, before we jump into your path at Logical, which we'll do on the next slide, could you talk about finding founder to fund fit during the fundraising process?
Yeah, that's a big one. I talk to a lot of founders these days, and that's one of the one areas that I try to focus on with them, because I think there's so much stuff in the blogosphere about SaaS, and everybody knows these brand name investors, the Andreessens of the world, the OpenViews are investors of the world, but it might not be the right fit for the founder at the time of their development. So there is such a thing as founder fund fit, and there's a really easy way to work backwards from that. Again, going off of the premise that money is a commodity, people are not, and it's people that make great SaaS companies, not necessarily the money that makes that work. So the rule of thumb that you can take is work backwards from how big do you think your company can be realistically, and try and match that with the fund size. So for instance, if you're looking at a company that can potentially get to 20 million in recurring revenue or 50 million in recurring revenue, and you go start talking to a fund that's 200 million or 300 million, that's probably not going to be that interesting. Like what Jack said, these guys are really looking at unicorn. Like, I know it's a joke these days to be labeled as a unicorn with all the drama around some of these companies, but the math is simple. If they're going to have a $100 million fund, they need to return that fund fully before they make any profit. So every investment that they do as a VC, they are looking at you thinking, will you return 100% or more of this fund? And so the math is really simple. $100 million fund divided by, let's just say they have an ownership stake of 20%, and that's $500 million. So that means you need to be able to have an exit of $500 million in order to return that money back to the investor. And that's how they're looking at it. So if you can craft a story backed with really good data, like what Jack was showing, like, hey, look at these early signs. If we just spend a little bit more in our customer acquisition costs, look what can happen here. And in order to spend that, we need you guys to give us money. And if you can paint that picture of a broader market, you can have a really good alignment. And I think a lot of founders make the mistake of going after the VC because of the brand name, when they should really think about, how big can my company really be? And then how does that translate into the fund size of this investor? And of course, of all the intangibles of who these people are. Do you get along with them or do you want to kill them? All those things.
Right. Great. I think, like you said, the math is simple, but it's easily glossed over, or just, I think that's a very simple way to put it and to help people understand it. So thanks for that. With that, if we can just step into, here's a, extremely detailed graph I put together of your capital path. So you can give us a little more detail here.
Yeah. So, like Jack, we're a little bit long in the tooth here. So, we started the company as a bootstrap company, with, being a services business, working on very large, complex litigation projects. We're talking millions of dollars, is insanely profitable. And then during the recession, we decided to blow that all up, and transition into a SaaS product. That's something that we really loved, the idea of, at least. And so that took a long time to build the product because we were funding it from customers, which is really hard to do. And if I had to do it all over again, I think I would have tried to raise money sooner rather than later, knowing what I know now, just because it's really hard on with SaaS companies, especially if you're taking a disruption from below strategy where you're going after that long tail of the market, and those people aren't going to just pony up six-figure checks to you. You'll be lucky if you get four-figure checks on a monthly basis. And it just takes time. And so, once we had the product built and we started to show a lot of signs of traction, with a nice month-over-month revenue growth, I think it was like 15 to 20% for almost 2 years there. We reached out to Jason Lemkin. He immediately saw what we were doing and signed up. He was our first investor when he was at Storm. He's currently on our board as an independent board director. And then most recently, a couple months ago, after even more traction from being laser focused on building a SaaS platform and not trying to juggle both services and SaaS, that's what the Series Seed enabled us to do. We had some pretty explosive growth and closed a round with OpenView Ventures out of Boston for $10 million. So that's where we're at today. Mostly customer funded, clearly, about 11 years of that.
Yeah, the typical overnight success. So, Yes.
Yeah.
There it is, right on the slide for you. Jack, I know we walked through yours in the previous few slides. Do you have any detail to add to that? I think you probably covered it for the most part, but happy to hear anything else.
Yeah, well, there's. I'll give a bit more color to the first 4 years there, because I think if this was a job interview, somebody would be asking, what were you doing those 4 years? Um, and I think for me and Ryan is a really interesting evolution as it came to thinking about how we were going to build the company. We started Clio with some very humble ambitions. We did not start Clio in 2008 thinking we were going to build a big, important, long-lasting company. We thought we would build a nice little product company that maybe threw off a couple $100,000 a year that Ryan and I could live off of. Ryan and I have known each other since we were childhood friends, and we were just looking for an interesting business opportunity, and started digging into the opportunity behind Clio, and I think just surprised at how large the opportunity looked, or we realized how large the opportunity was, rather. And another interesting kind of shift in our thinking was around financing. We originally really subscribed to the 37 Signals kind of take on bootstrapping a business, and subscribed to their general worldview that venture capitalists are out there to take over your company and screw founders, and why would you take investment from VCs? And that was very much our mindset in 2008 when we started building Clio. We really wanted to bootstrap the company and be in full control of our destiny, and build a lifestyle business, really, I think is a good way of putting it. And the realization we had over the first, I would say 2 years of building Clio, it took us a while for this light bulb to go off, but and Christoph Jans, actually, who approached us fairly early on in the development process for Clio, helped us come to this conclusion. Excuse me. And which was, he said the dynamics of SaaS are quite a bit different than what we saw with on-premise software. With on-premise software, I think you saw a lot of companies build nice little lifestyle businesses that threw off a couple $100,000 a year in EBIT for their founders, and were nice little lifestyle businesses. But in the SaaS world, you have this winner takes all dynamic, or at least a winner takes most dynamic, where those lifestyle businesses get squeezed out. There's going to be some Salesforce.com type player to enter in the legal industry that will just suck the oxygen out of the room and leave that cute little lifestyle business that we wanted to build by the wayside. And Ryan and I decided, look, we need to actually raise some capital here, and we want to be that Salesforce caliber company in the legal space. And our mindset shifted 180 degrees, and we decided we need to go big or go home. We are going to build a big, important company, and we want to own this space, and we're going to be the winner that takes all, was our hope. So we went out and raised that first $1 million Series A round with Christoph and some other investors that came along with Christoph in that round, and that closed in 2010, and that paved the path for our $6 million Series B. My other comment, for anyone, I assume most of the listeners here are building SaaS companies. The other light bulb that went off for us is that 37 Signals, they're an exception. They're a company that has managed to raise capital, or managed to build a big and substantial company without raising a lot of capital. But they've got a very unique set of circumstances that have enabled them to do that. Most SaaS companies really have this paradoxical quality where the faster you're growing, the faster your burn rate is going to be. All of your customer acquisition costs are completely front loaded, and for you to earn your money back, you're going to need to raise capital to fund that growth and get you through that trough of customer acquisition cost before you come out profitable on the end of that journey. So the something that became clear to us over those first couple of years is just the economics of SaaS, which in 2008, 2009, SaaS was still a bit of a dark art. People were still trying to wrap their arms around SaaS economics. It's well known now, thanks to guys like Lemkin and Christoph blogging about it and helping spread the word. But back then, it was much lesser known, and took us a while for that light bulb to go off. So that's our funding path.
Yeah, Brian, real quick, I want to tag on to the 37 Signals thing. So Jack totally nailed it here. I was my thinking was totally jaded by reading a lot of 37 Signals content. We were actually featured on their Bootstrapped, Profitable, and Proud series on 37 Signals blog. So
I didn't know that, Andy. I'm going to go dig that up. That's amazing.
Yeah, I might have actually had hair there. You'll see a picture of Shin and I on there. Look up Logic and Bootstrapped Profitable. You'll see it. It's pretty funny. I think I have a quote in there saying like, I had the delusion of creating this. Anyway, my point is they did such a fantastic job writing content, really admonishing VC and taking money. But reality, you got to look at your own business and see what it's going to take for you to do what you want to do. And if you want to be a lifestyle business and you don't think that there's going to be another Salesforce in that space, which very well could be true, that's fine. But if you're in a competitive space where there are competitors raising money and you aren't, maybe you're doing incredibly well and you've got that bootstrapped model, but it is tough. As Jack hits the nail on the head, all of your costs are completely front loaded. And unless your customers are just paying everything up front and you've got, fairly low overhead, a competitor that's going to raise a lot more money is just going to move faster than you and push you out of the market.
Right. Thanks, guys. Yeah, it's a big shift hearing you guys talk about that both of you made in your businesses and the view on your businesses. You didn't start out of the gate saying, I want to go raise boatloads of someone else's money and scale this thing to the moon, right? It was a much more measured approach and, somewhat market driven for each of you. So interesting to hear. So with that, now we've talked about bringing money into the business. Let's talk about once you have that money in the business, how do you not totally screw it up? How do you, maintain and get value from these relationships with people that have come into your business and put their money, other people's money into it? So with that, we've closed the round. Awesome. Big sigh of relief. There may have been some lumps taken on both sides along the way. So how do you move from the negotiating table to kicking off your partnership? Jackie, Andy, just go ahead and chime in on that.
Sure, I'll kick things off here. So like you said, Brian, there's some lumps that you might have acquired over the course of the negotiation process. It's getting to a term sheet can be a hard and a contentious process. Going from the term sheet to a final set of legal documents is another long path of hard work, and it's a tough way to kick off a relationship when you've just gone through this kind of brutal negotiation process. And there may have been some terms that landed at a compromise that both parties might not be thrilled with, which is probably the definition of a good compromise. But you need to get past that and start working together really effectively and leave all of that on the field and say, okay, we've got the hard part done, and make sure that you're entering into this now collaborative and hopefully healthy phase of your relationship with that term sheet and that USA negotiation process behind you. So, I think some simple things I would recommend on this front would be a closing dinner, getting everyone together, celebrating the fact that the round is done. Get a bit of a preemptive strike on setting up that new tone for the the relationship, setting up all the tools and communication methodologies you'll be using, which we'll talk about in a minute. So, so again, just realize that there's going to be some butting of heads in the final phases, and to be very conscious of the fact that's something you need to slough off and put behind you after the round is closed. Andy, what are your thoughts?
Actually, nothing. That's exactly what I would say, Jack. So,
all right,
Andy, why don't you take the next one for us then? So, do you, did you just peace out for 6 months and go on vacation and go dark, or probably not the best idea?
Yeah, I got a new Tesla.
Awesome.
It's been pretty sweet. Yeah. So, it's just like think of it like you're hiring this investor to come onto your team as just like an employee, obviously with different terms and expectations, but they're not your boss, they are not your supervisor. If you've chosen correctly, they're there, you're there. Going into it, you might not have spent a lot of time getting to know your investor before you actually sign the term sheet and money's in the bank. That said, like I always recommend, like, try and get to know these people. Like VC is an illiquid asset. So, it's something where you just can't break up with someone. You're going to be stuck with this person, whether you like it or not, for the next 7 to 10 years in most cases. That's the life cycle of a fund. So, pick wisely, right? And because you probably don't know this person for very long, you have to build trust. And the best way to build trust is with transparency. So don't hide from anything. That's my number one bit of advice. And as we all know, founders on the call, the highs are highs and the lows are low, 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 low. And when it gets low, and things, shit hits the fan, there's a tendency, I think, just human nature, not to show the negativity. But investors know that. They know that you're going to have lows, and they know that you're going to have highs. So celebrate the highs, and trying to understand the lows and know that they're coming. But be transparent about it. One of the things that I do, and Jack will talk about this too, is I do it every single weekend. On Sunday, I write out an investor email that goes out to the entire company and our investors and advisors, and it tells them what happened that week. And it also shows, where are we at from a cash position, how much new revenue came in, how much, which deals, which customers churned, and how much that represented. And that's just all about, building transparency, which ultimately I think builds trust.
Yeah. So I'd add on to the, kind of kicking things off, maybe I think thematically agree with everything Andy outlined there. I think from a nuts and bolts perspective, which is I'll focus on that side of things a bit more, maybe. Setting up the tools and the communication cadence you're going to be using with your investors. I would recommend, for example, choosing a tool like Basecamp over email, for example, as a place to centralize board communications. Just makes it easier to have a centralized repository, and you don't have dumb stuff like the wrong people getting on an email thread, or those messages maybe getting distributed more widely than you would like. A little bit more controlled with a centralized communication channel. Like Andy said, I think be very forthright about the key metrics, and a really regular cadence for updating investors on those metrics. Stick to the same schedule, and whether it's good news or bad news, always send that email out. If you have a monthly report on the first of the month, send out that email on the first of the month, whether you've got good news or bad news to share. You don't want your investors wondering if it was a bad month because they haven't heard from you for half a month. I would also comment that in my experience at least, as your company evolves and you get later stage, the frequency of communication with your investors might change. When we were doing our seed and Series A stage rounds, we had we had weekly calls with our investors, because I think especially when you're in that very early trying to figure things out kind of phase, you need a very tight communication cycle. That's where the investors can add a ton of value. I talked about Christoph Jans earlier. We had weekly calls probably for the first 2 years of the company's existence, and his coaching conversations with us in that time frame were so valuable. So highly recommend that more intense collaboration in the earlier days, and then as you evolve and get more confident in what you're doing, and the organization gets bigger, that communication frequency might dial back to, for example, quarterly board meeting and a monthly update call or something along those lines. So things will evolve over time for sure as well.
Guys, quick question. So it's a great muscle to develop. I agree. I think it's a bit of a tedious and maybe scary one to develop, but I also think it's beneficial for you guys as well. I imagine, to sit down, to think about the business critically on a weekly, monthly, whatever it may be basis, and send out that communication. What do you expect, if anything, in return from when you hit send on that email?
I can answer from me. Like, I don't expect anything unless I'm asking a question. So sometimes we'll ask for help, like we just announced some new roles that we're trying to fill, or we're trying to get connected with a certain customer. I might mention that in the investor update, because it's kind of crowdsourcing a little bit, right? So maybe there's an employee that sees that and goes, "Oh, I know somebody that works there," or an investor sees it, or I'll call them out, or I'll send them an individual thing. But in general, I'm not expecting any kind of applause when we do well, or scrutiny when we don't do well. So that's my take. Jack?
Yeah, I think in our experience, or in my experience, the response, number one, Andy made a very important point there. Make your asks explicit. I think your investors if you have good investors, they'll be anxious to help you out, but you do need to be explicit about how you need help. So don't leave, the fact that you desperately need to replace your VP marketing, or that you need to help hiring a new VP of sales as a implicit statement in your update email. Make that an explicit point and an ask, and if you can, identify specifically how each member of the board might be able to help you. They'll be positioned in different ways, maybe even in different cities, with different networks, and able to help you out in different ways. So make those asks explicit, and you'll get the help. And I think investors, when there's good news to celebrate, if there's investors listening to this call as well as founders, I imagine, I think that your founders, the people you're on the board of, want encouragement and want those high fives, and want the "hey, you did a good job" kind of comments. Just like I know people on my team want those comments from me and that feedback from me. And I think if there's one thing I'd be critical of myself as a leader, is I'm always dissatisfied. I always think we could do something a little bit better, and I don't give out enough good job kind of comments to my team. And I think any leader, whether you're helping lead a company on a board, or whether you're CEO with a team, giving that positive feedback is something that always goes a long way. So hopefully you'll see some of that unprompted feedback from your board when there's something to celebrate.
Yeah. Good job, Jack.
Thanks, Andy. Appreciate it. You made me feel better.
All right, thanks, guys. Let's move along. And founders, just to reiterate, extremely important to communicate. So if there's anyone on the line not currently doing that, please start doing that. There's a lot of good update email templates out there on the internet, and I'm sure any of us could send you one as well. So let's talk about aligning interests. So, as you continue to bring more and more capital into the business, potentially an A, a B, a C, and beyond, how do you go about, managing potentially even competing interests between your investors as you bring them onto the cap table?
This is Andy. Jack's got more investors on his board now. He's a little further along than us. My board's fairly small. I've just got 3 on the board today, and I think it just comes down to expectations. If you want people with different points of view, like you don't want everybody to be like rah rah rah, right? That's not super helpful. You need people to really dive in and kind of like what Jack just said, like we could be doing better, because you're right, you could always be doing better. And questioning, your overall strategy and the results and those things, like what could we be doing to do better, and not just celebrating the status quo. For my board and aligning interest with my group, I just make it clear, like, listen, we are here to do what's in the best interest of the company, and in order to do that, we have to put our customers first, right? And let's work backwards from that. So move the egos aside, which I've got Limkin on my board. I've got Alex Mendez from Store Ventures on my board, and Blake Bartlett from OpenView on my board. And they all have really good perspectives on the business, and they all also have good sized egos, and you have to control that. And I think the best way to do that is just set the groundwork of the reason why you're there. And if you can remind people of that when things do get heated, I think most rational people will calm down and go, okay, I get to check my ego.
Right. Jack, anything to chime in with here?
Yeah, I think Andy made a really important point in terms of you don't want a bunch of yes men. You don't want a bunch of people just patting you on the back saying great job. I've always framed the most valuable thing a board member could come to a board meeting with, or just come to the table with in general, is something I had never really thought of. Something that challenges my thinking, something that lets me reframe the problem in a new light. And that's a rare talent to find, and so valuable if you can get a board that brings that to the table, because otherwise that board meeting just becomes a administrative process that doesn't actually help advance the business. But if you can build that board that challenges your thinking, brings new perspectives, pushes you and pushes your executive team, that's a huge win. I'd also look for diversity in the board. There's a huge body of research now talking about how diverse teams perform better than self-similar teams, and building a board where there's that diversity can really help. And finally, kind of on this aligning interest question, I think in general your board is going to be pretty highly aligned in that everybody just wants a huge, great outcome for the company, whether that's going IPO or being acquired for a huge amount of money, whatever the ultimate outcome looks like. Everyone's aligned in wanting to see that big outcome. And I think where you see some pathologies is if things aren't going super well, and maybe things like liquidation preferences start kicking in. There may be situations where the investors' interests aren't aligned, and one investor might be advocating for a company shutdown, for example, because they get their first in line on the liquidation preference, and you as a founding team and your common shareholders are going to be left holding nothing. So that's one situation where different classes of shareholders could stand to see vastly different outcomes from certain kind of undesirable to moderately desirable outcomes for the company. I think everybody's perfectly aligned when there's a terrific outcome. That's clear. But for those kind of middling outcomes, you can see a lack of alignment, and just something for, I think, the founders to be that are listening to this to be aware of, where you can see lack of alignment and maybe different motivations in different investors on your board.
Yep, very important point there. And just so everyone knows, we are officially into our kind of Q&A section and time here. We've got about 15 minutes left. So should you have any questions, now's the time to throw them into the chat window. And really on these last few slides here, we kind of have taken the conversation to really the board level, right? And kind of your investors sitting on your board. So the last couple of slides here are really, how do you maintain support through these tough times, as well as how do you maximize value, right? It sounds like having investors can be a hard thing. How do you make sure you're really getting the juice? How do you make sure it's worth it?
Mm-hmm.
So pretty open-ended there, guys, but just touch
on. So the first question was, again?
The first one's really about, support. And we've got some questions coming in now that may be better about mine. But this is a bumpy, long road, right? How do you maintain support from investors and then pair that with actually getting value, not just support?
Well, doing what you said you would do. That's probably number one. And with investors, I mean, and I've made this mistake myself. There is the tendency to, you want to puff out your chest a little bit and we'll 10x revenue next year, when last year you maybe 2x revenue or 3x revenue. You want to be a little bit conservative. It's the old under promise and over deliver approach that I think works really well with investors and in general life, right? But I think it goes back to a lot of stuff we've already talked about, which is establishing trust via transparency, and obviously not giving up. Like as a CEO and founder, this is your job to steer the ship, and if you lose hope in that, it's really obvious, I think, to investors and employees alike that your heart's not in it anymore. So you've got to constantly have that positive outlook that yes, you might be on a downward spiral, but you'll pull out of it eventually. And I think that's how you can really align people in the right way. So.
Yeah, I think it's a great point. I think saying what you're going to do is probably one of the easiest ways of building support and confidence in your board. And that's not always just hitting your financial targets. That's something that we should all be aspiring to do, but especially the execution related things, the tactics of how you're going to get to that revenue target, lay out a concrete plan and execute against that plan and hit your targets. Show the board that you and your team can deliver against a plan. I think another way I frame the board relationship is one where you don't want to be going to your board with open-ended problems. You don't want to say, revenue stalled out and I don't know what to do about it, or you don't want to be going to them saying, you've got some substantial business problem, have no idea how you're going to handle it, and just toss it over to the fence for them to chew on and come back to you with a solution. I think investors are far removed from the day-to-day of the business and have really brought, as CEO, they're counting on you to be closest to the business and the person who can synthesize the data that's at hand and come up with a solution for the challenges you're facing, or at least maybe a range of possible solutions that you could bring to the board. So, again, to Andy's point around, making sure it doesn't, ever appear that you've been, defeated. I think part of that is always having a solution or a set of solutions in mind for the challenges the business might be facing, and look to the board as a sounding board. Excuse the pun, but bring these a universe of solutions to the board. They'll be able to give you great advice based on their experience and hopefully some level of wisdom around how your different courses of action might play out. But that's really, I think, an important part of the dynamic, and something that they're looking for in you as CEO is coming up with the solutions to the challenges you might be facing.
And Jack, could you touch on maybe, you mentioned having a diversity amongst your board to be a good thing. How do you, and at what point in the company or board formation do you start to think about specialization of board roles?
So I think, there's a limited amount of the diversity I think you get in the perspectives, in some levels going to be actually informed by the investors you bring on board and the assigned board or board seats that go along with that investment. So, pick investors that you feel are bringing something new to the table, and then make sure you have your independent board seats to assign out to people that you feel might be complementary, help round out blind spots in your board composition. You've got a limited amount of control over exactly what your board looks like, I think, based on the investors you bring on board. But those independent seats can be super important to bring a valuable external and more diverse perspective to the board meetings.
Okay, guys, we've got a few questions here from the audience I'd like for us to be able to touch on. We've got 8 minutes left, so maybe a minute or two for each of these, and see how we do here. So here's taking us back to earlier. Maybe you can help us understand this, Andy. Can you describe how to find investors? Is a question, right? So Andy, you had been running your business as a services business for quite some time. You identified Jason Limpkin somehow, some way, as a great investor for your business. Can you walk us through how that came about?
Cold emailed him.
Awesome. Great hustle.
Yeah, just spam people. That's all you need to do. This is going to sound a little strange to SaaS people. We live in the internet, but get out of the internet. Go meet these people in person. Investors love to go to events and talk on panels and do all these things. And in fact, that's actually where I first met Limpkin, and at his first the SaaStr Summer Social or something like that 3 or so years ago. Jack, I think you might have been there at that time. Or,
Yep.
That was a fun time. So, getting out and meeting these people, because if you think about it, like, you can try and contact these people online, and that's fine, or get introductions, and it's always recommended. But if this is somebody that you truly want to get to know better, you're not going to get to know them over email. And then a call is okay, but meeting these people in person is even better. And the best way to get that done is to actually have real traction that's impressive for the type of investor that you're going after. It wouldn't make any sense for you to, I think most likely, trying to get a meeting with, Mark Andreessen. I think he's busy trying to buy Twitter right now. But if you had, 10,000 in MRR and you're growing at, say, 5% a month or 10% a month, that's just not interesting to that type of investor at this stage. So, my learning here is get out of the office, go meet these people in person, build those relationships over time. If it makes sense, maybe you meet this person and they're just a complete jerk and you would never get along. Which is really important because, again, you got that 7 to 10 year time frame. Do you really want to have this person on your board, having these difficult conversations if you can't, stand each other?
Not the most pleasant situation to be in for, again, 7 to 10 years.
Yeah, I'd agree 100% with everything Andy said there. I'd also, just underscore the fact that get to know your prospective investors or the universe of prospective investors way before you have to ask for money, way before you're looking to close around. Everything around what we've talked about is to building a good board relationship, I think, falls back to getting to know the people that will ultimately end up being on your board really well as people, as individuals, prior to signing a term sheet. And you get to do that by, basically like dating them before you get married. Experiment with making an ask of them before you sign a term sheet. Can you help make an introduction to, the CEO to come in and want to sell my product to? Make requests of them and test them. See what the responsiveness to your emails and your asks are. See if they're helpful. See if they follow through on their promises. See if you have good personal chemistry. Go out for a dinner or a lunch. I think that's a really crucial part of the relationship building exercise. And when it comes to taking money from them down the road, hopefully that will just seem like an obvious and next natural step to a relationship that you've already built up.
Yep. Just like hiring, if this person matches with your culture, that's a good check mark, right? And then you got to dive into the other intangibles.
Yep. Now, we've got another question on board members. How do you keep these folks accountable? Are you giving them, action items? We've talked about asks that we may have specifically, but do you hold them accountable? And if so, how?
I may just have a high functioning board, but they hold themselves accountable. Like I think these guys just, they look at almost their sole real value proposition as being able to be helpful and follow through on the things they say they're going to do. And they're doing stuff like on the taxi ride back to the airport after a board meeting, following through on everything they committed to do. Like it's often done within, what their to-dos are complete, by the time they get on the plane to fly home from the board meeting.
Yeah, totally agree. Type A, right?
Sorry, what was that, Andy?
I said, most VCs are type A people, and they live by a to-do list. So it pangs them to not actually check those things off the list. So you really don't have to do much. I mean, I haven't had any issues, and Jack's right. Like these guys will hold themselves accountable if you pick the right board members. I mean, maybe you got shitty board members. I don't know.
Yeah,
but,
and Jack,
like an employee.
By the time someone's on your board, you've built that relationship and probably had some to-dos for them to complete for you along the way. So
yeah.
All right, great. We've got 2 more minutes and 1 more question. Interested in you guys' perspective here. Got my own. What do you recommend for a company that's already doing $3.5 million in revenue? We don't have investors, but it'd be really helpful for scale. Growth has been all self-funded.
Depends on the market that they're in and what their overall goals are. And it's kind of a hard question to answer. Can they give a little bit more information?
Infrastructure as a service is what
God. Not
pass.
Take on that.
Next question.
Yeah, fair enough. I think that's pretty much all we've got. I don't know if you guys have anything.
Well, here's one parting thought that
absolutely
didn't fit into any of the slides, but I think it's important to realize that a board relationship and building a positive relationship with your board is more than just a series of 3 or 4 hour board meetings. I'd highly recommend setting up board dinners for the evening preceding your board meeting. Everyone probably has to fly in the night before anyhow, so get together for a few hours and get to know each other outside of the board meeting room. I think that's really important. Something else we've experimented with and is hugely successful to really help build stronger interpersonal connections and build a stronger team within our board was doing a once a year board offsite. So we held our board meeting in Whistler and did it. We're based in Vancouver, by the way. So Whistler is an hour north of Vancouver, and we did our more of a full day board meeting where we could have a more relaxed, more thorough discussion about the company's future. And then we went skiing the next day. And it was just awesome to be able to hang out with, the board over a more extended period of time. And even for the board members to get to know each other and understand each other in a deeper way. So, relationships are about creating opportunities to get to know each other. And, your job as CEO is to create those opportunities for you and for your board and look to those opportunities outside of the boardroom.
That's great. Thanks for that. I actually had one more question at the last minute, as I'm known to do. But Andy, if you guys have another couple of minutes, we're not going to get booted off the line here.
Yeah.
Andy, you said earlier on to be transparent, right?
Mm-hmm.
Transparency is the best way to build trust and build the relationship. How transparent? How much of these lows do you actually share with these?
Yeah. That's a really when you have investors on, they definitely get to see more of how the sausage is made, so to speak. But you don't need to go into all the slaughtering and blood spilling that happens. There's just it's a really kind of use your best judgment. You don't want to scare the shit out of people. That's probably a good rule of thumb. But you also don't want to try and hide from anything that's important. So, for instance, like if you're running out of money, like this has been a problem in the Bay Area tech scene for years, where all of a sudden it's like, oh shit, this company is no longer in existence. What happened? That just happened at Mode Media. Once a unicorn, right? All of a sudden the employees are gone. There's just done. Poof, gone. And if you're running out of cash, I mean, cash burn, it is what it is. Like if you are burning $200,000 a month and you have $600,000 in the bank, you are going to be out of money in a quarter. That is just fact, unless you do something about it. So, letting employees and investors know about those types of things is really important, and it's the right thing to do as a human, because those people depend on you and their families and the benefits associated with that. And to screw those people over is a really shitty thing to do. Just use your best judgment and try not to scare the hell out of everybody.
Well,
yeah, I would agree, and be a good human. So I think it's a good wrap there for us. Andy, Jack, thank both of you guys so much for joining and sharing your experiences with us all today.
Cool.
Thanks for having us. It's great.
See you, Jack. Thank you.
Andy, thank you.
All right. Bye, guys. Thanks, everyone. And as we mentioned, we'll have the recording and the slide deck for you guys here in short order. So thanks so much. Have a great one. Bye.